Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. When inflation is low and stock market valuations are also low, that is one of the most ideal moments to be buying stocks. When valuations are high and inflation is high, history shows that the market performance looking forward is poor. That's basically what this chart shows you. It's the SP 500 PE ratio, so valuations added to inflation, right? So a very simple formula that gives you a valuation metric that goes back to 1978 here. And it currently suggests that we're at valuations similar to the one that we had at the very top of the dot-com bubble, or at least when the dot-com bubble was popping. Now, obviously, 2001 was a very poor moment to be in the market. Yes, the market had moved down already throughout 2000, but if you look out another year to 2002, the market was even lower, and it actually took until 2012, so over 10 years later, for the market to really provide steady gains on a sustainable basis. So is that what's in store for us, this type of massive period of consolidation in the market throughout the rest of the 2020s? Is this also something that we should really be taking into account for our positioning today? Is this predicting basically that this bear market that we've seen throughout 2022 is only just getting started? That is exactly what we are going to be talking about in this video. Before we dive into that, do not forget to hit the like button just under this video if you enjoy it, if you find it useful, because that really helps the channel out. Now, without further ado, let's get right into it. Now, what I want to show you here, to put a lot of context around the valuations of the S&P 500, is this chart here that basically shows you the inverse of inflation, right? You can see this red line is basically the inverse of the CPI, and then to that you add 20, right? That's why it's called the rule of 20, and what that is supposed to do is it's supposed to give you a blueprint for where PE ratios should be. And you can see that actually works pretty well right until 1935. So almost 100 years worth of data where this rule of 20 has accurately predicted where valuations should theoretically be. Now, of course, this is to take with a grain of salt. It's not always perfect, but it gives you a pretty good indication of how expensive stocks are or how undervalued they are, right? That makes sense. This is really useful to give you a rough idea of where valuations should be. So if this blue line, the PE ratios, are trading below where the rule of 20 currently is, it's telling you valuations are actually low, or actually lower than where they should be, right? And that makes sense. Periods where inflation is low and stable, like this period right here between 1953 and 1963, or for example 1983 all the way to 2020 right here, very low and stable inflation, it makes sense that valuations are elevated because the Fed can inject a lot of money to stimulate the economy, stimulate asset prices, and so stocks go up in this type of environment. Now, on the other hand, when you have PE ratios that are above the zero line, it means the stock market is overvalued. But you can see that rarely happens. It happened in 2000 right here. It happened in 1973 right here very briefly. It happened in 1961 right here, and briefly in 1946 as well. And so in all of these cases, this indicator did predict that valuations were expensive and that they were poised to go down. You can see they went down here, they went down here. In 2000, they also went down. And so that leaves us to today. Does that mean that we should be much lower in terms of valuations, right? And you ask most people looking at this chart, and you would say yes, valuations do still need to come down quite a bit, and that is perfectly fine. If you're looking at this chart, you're seeing the data for what it is, and you think that means the stock market is still overvalued and it still needs to come down to where the rule of 20 is currently suggesting it should be at, which is 12.3 as opposed to 17 where we currently are right now, which would mean another 20 to 30% drop in the market for valuations to come back down to 12. And that is reasonable to expect that. You look at history, and the majority of the time that happens. Now, I do have a counter argument to this, and I'm going to show you that in just a second. So make sure to pay attention very carefully and also share your thoughts on what you think in the comments down below. And of course, hit that like button on the way down if you're finding the information, the data, the charts, and the presentation that we put together for this video, if you're finding that valuable. Don't forget to go ahead and do that. Now let me go ahead and show you my crazy theory for why valuations might not be in a rush to come back down to 12, at least not just yet. The way I see it, we are currently in a very similar situation to 1969, 1972 right here. Now, not because we're going into a period of stagflation, right? Although that could definitely be the case over the next 10 years that we go into a period of stagflation. But that's not the point I'm trying to make. What I'm talking about here is from the standpoint of a market behavior and market psychology standpoint. Now that sounds ridiculous, but let me make my case. At this moment, right here in 1970, this is the first time that inflation broke out. It broke out above 5% for the first time in 20 years. The last time inflation was this elevated right here was 1953. So that is almost an entire generation of investors that got used to, first of all, low inflation and rising valuations, and even a steady period where valuations stayed elevated for a significant period of time because the Fed had been providing easy money throughout this period, a stable monetary policy that was really entirely focused on keeping unemployment rate low and keeping the economy strong, and they didn't care about inflation. And all of a sudden in 1970, right here, you've got inflation that reaches 6% for the first time since 1951. So the psychology of the market back then, seeing this surge in inflation, was of course that it was going to come back down very gently, that this was just going to be this one-off thing, and that we were bound to see once again, just like the 1960s, a period of low, steady inflation with stable monetary policy. The consensus back then was definitely not that we were heading into a period of stagflation where inflation would run out of control over the next decade. Now, if that sounds a little bit familiar to today, then you would be absolutely right, because that's exactly what's happening today. Consensus right now is that the Fed is going to be able to bring inflation back down to 2% and keep it there for the foreseeable future, that we're not going to have a policy mistake where the Fed under-tightens and creates a period of stagflation, or possibly even a period of deflation that's extremely bad for the markets, as we saw in 2008. But that's why, if you zoom in here, as soon as you had the first sign that inflation was rolling over here in the 1970s, so in other words, right here, that's when the market took that opportunity to skyrocket back up to high valuations. So you can see that right here. As soon as inflation rolled over, look at where valuations got straight away back up to almost 20, despite the fact that inflation right here at this moment in time was still at around 5%. So that's where I think we currently are. And of course, we could be wrong on this, especially if inflation doesn't come back down, but we think it is. And the fact that it's coming back down right now, as soon as the Fed gives the signal, which I think is not too far down the road, market participants, greedy market participants, will bid up the price of the stock market again. They will get back to high valuations, pricing in the fact that we're just going to return very gently to a period of steady monetary policy. And so that actually gives room for the market to appreciate during this period of disinflation. Now, whether or not we actually get back to 2%, that's another question, and I really don't think that's very likely. I think the odds of this happening are slim to none. There's almost 0% chance that we just gently come back to 2%. The odds that the Fed is going to over-tighten or under-tighten are very high, but of course that is a problem for another day. I do hope you guys enjoyed this episode. If you did, don't forget to hit the like button. It makes a world of difference. And of course, subscribe to the channel if you are new here. Now, in the meantime, I wish you good luck on your trading, and see you next time.